All right, thank you everybody joining us for our second episode of Plan, Protect, Invest, Scroy Lolly podcast. Today is our January episode, so we have a few things for you guys. First, we'll be going over some contribution limits, rule changes for 2026, then some estate planning, and finally, we'll be finishing off with a 2026 review, a New Year's check-in, talking about some budgeting, emergency fund, and making sure your portfolio still matches your 2026 goals. So Matt, why don't you start us off with some of the highlights of the year with the new 2026 contribution limits and rule changes?
Yeah, it's a good starting point to go off of some things that are changing into this year. Some things didn't really change last year, specifically around the IRA and Roth IRA contribution limits. They didn't change at all in 2025, but they are changing here for 2026. So if you're going to be younger than 50 by the end of this year, you can put in $7,500 into either an IRA or a Roth IRA. And then if you're going to be 50 or older by the end of the year, you can put in up to $8,600 into an IRA or Roth IRA. So that's a pretty nice increase from last year. And a couple qualifications that we need to meet before you can actually make a Roth IRA or traditional IRA contribution. Of course, you need earned income from either working a job or being self-employed before you can actually make those IRA or Roth IRA contributions. And there's also an income limit to these as well. So if your income is higher, than some of these amounts, you won't be able to make those contributions either. And those have increased for this year as well, the income thresholds to make those contributions. So we'll look at the Roth IRA first. If you're a married couple filing a joint return, the income limit for that, the income phase out is $242,000 between $252,000. So if your income's below that, you and your spouse can make, and if you have enough earned income, can make a full Roth IRA contribution. And if you're single, then the threshold for your income is going to be $153,000 to $168,000. Again, that's increased from last year. So if your income's below that minimum threshold, you can make your full Roth IRA contribution. If it's above that higher threshold, you can't make any contribution whatsoever. And then if it's somewhere in between, you can contribute a partial amount, depends how much you are over that lower limit. So it's good, that those have increased, from last year to this year. It means you can put more money away for retirement, which is great. If you were making monthly contributions to either your traditional IRA or your Roth, with those thresholds being increased for your contributions, it's good to look at how much you're putting away each month to make sure that you'll hit the max if that's what you want to, accomplish for the year, because that would be different from what you're putting in every single month last year. I know personally for my clients, that I work with personally, any of my clients who are maxing out monthly, I always reach out to them at the end of December because we'll know if the contribution limits have gone up by then, and basically ask them if they want to, increase their monthly contributions. So that way they will max out, for the year. Now, if you are considering making a traditional IRA contribution, income thresholds are a little bit different for that, and the rules are a little bit different because it's really not only going to be dependent on your income, but also dependent on if you're covered by an employer-sponsored retirement plan through work, like a 401k, 403b, deferred comp, or 457, thrift savings plan, or even a pension. Any of those things constitutes being covered by an employer-sponsored plan through work. So if you want to make a traditional IRA contribution, not only do we have to look at that, but then we also have to look at your income as well. Now, if you aren't covered by an employer-sponsored plan at work, maybe you're self-employed and don't have any, plan through your, business, or maybe you do work for an employer that doesn't have any sort of retirement plan for the employees. Doesn't matter how high your income is, you can make the IRA contribution and deduct it. Now, things get a little more complicated if you are covered by an employer-sponsored plan, which majority of people are. then there's going to be an income threshold that you'd have to, meet in order to get that. If you're single this year, the threshold is $81,000 to $91,000 of incomes. If you're single, if you file a single return, so if your income's below that, you can still be covered by an employer plan at work and still deduct your full IRA contribution for the year. Things with this become a lot more complicated if you are married and you and your spouse file a joint return, because now instead of looking at one spouse's employment and seeing if they're covered by an employer plan or not, now we kind of have, two different, people's situations to look at. So the rules are a little bit more complicated there. Again, real simple. If both you and your spouse are not covered by an employer plan at work, you can both make your full IRA contribution and deduct that on your taxes. But if both spouses are covered by an employer-sponsored plan through their employer, then the income threshold for that is $129,000 to $149,000 for this year. Again, that's increased from last year. Again, if you and your spouse joint income is below that $129,000, you can both make your traditional IRA contribution, get the full deduction on your tax return. If you're over that amount, you won't be able to deduct that contribution on your taxes. Now, things become a little more complicated further if one spouse is covered by an employer-sponsored plan at work and the other is not. So if the spouse who isn't covered by an employer-sponsored plan at work, basically they have a higher income threshold to make that IRA contribution and deduct it. And that for this year is $242,000 all the way up to $252,000. That's the beginning and end for the threshold. So if the joint income is below $242,000, one spouse could potentially make an IRA contribution for themselves and deduct it. The other one, the one that's covered by the employer-sponsored plan, then they're going to fall to the 129 to 149 thresholds for that. So that's just kind of where things get a little more complicated, is if we do have, a married couple and they are considering making and deducting a traditional IRA contribution.
So, Matt, tell us for the viewers, what does it actually mean when you say participating in a workplace plan?
Usually it typically means that you're actually putting money away, and if you have a pension, a lot of times the employer is going to be the one putting, the money away for you in combination with yourself. But usually means that you're actively participating it and can, and are actively making contributions, or your company is making matches, let's say in your 401k, that would count as well for it. So that's really typically what the IRS means when they say covered by an employer plan through work.
Yeah, so good stuff there with the IRAs. So now let's move into the new 401k limits.
Yeah, so with actual employer-sponsored plans such as 401ks, 403bs, deferred comp or 457 plans, the thrift savings plan, those type of accounts, those contribution limits have increased as well from last year to this year. So what we're looking at for this year is the most you can put in your own money that you can contribute if you're going to be younger than 50 by the end of the year is $24,500. And again, that's your own money. That's not counting any employer match, which is great. So it's a pretty large sum that you can put away of your own money into those plans. Now, if you're going to be between 50 and 59 by the end of the year, we actually can take advantage of what's called the catch-up contribution of an additional $8,000 that we can put into those plans, bringing the total to $32,500 for the year. And things get even more interesting if you are going to be between ages 60 and 63 by the end of the year, and you can actually put in what's called a super catch-up contribution, and you can actually put an extra $3,250 on top of the original $8,000 catch-up contribution, bringing the total to $35,750 for the year. Now, the only caveat with that extra super catch-up contribution for those age 60 to 63, it is plan specific. So it basically has to be allowed within the specific 401k plan. Basically, the IRS says that 401k plans, retirement plans can offer that as an option for the employees, but the plan itself has to basically specify if they allow for those super catch-up contributions, which are relatively new.
So, Matt, tell us about the new change with these catch-up contributions for the year.
Yeah, so there's a really pretty big new rule regarding those catch-up contributions, whether it be the standard $8,000 catch-up contribution or the super catch-up contribution. Applies to both of them. And this is brand new starting January 1st, 2026. Although it was introduced originally at the end of 2022, got kind of kicked down the road on it, and now it is effective for this year. And that is basically if your income was over $150,000 from the previous year, if you are making catch-up contributions to an employer-sponsored retirement plan, you have to make those catch-up contributions on a Roth basis, basically meaning it has to go into a Roth 401k, a Roth 403b, et cetera. It cannot go into a traditional 401k or other workplace retirement plan. It has to go into a Roth one. Basically means that these employees who are making catch-up contributions, they cannot deduct them anymore. It basically means that the IRS will get a little more tax revenue, in the short term. Now, in the long run, the employee will get to use that Roth money, or their beneficiaries will get to use that Roth money, completely tax-free, which is nice. But in the short term, it definitely does create some increased revenue, for the government. And again, it's based on your income from last year. And if it's $150,000 is the threshold. And what they're actually looking at is what's called FICA wages. So on your W-2, in box one, you're going to have your wages, but there's, it's not really your true gross wages, because a lot of times if you are contributing to a 403b or a 401k, it's going to, that box is going to be reduced by how much you're contributing to those pre-tax retirement accounts. Your FICA wages don't get reduced by any contributions you make to a 401k or any other employer-sponsored retirement plan. So that's truly like your gross income for the year. It's really hard to reduce that. You don't really get any tax deductions there's not really a way to reduce that. So if your income, is going to be, at that or higher from last year, unfortunately, if you're, making those catch-up contributions, you do have to put them into a Roth account. And typically, if you're making catch-up contributions, right, you're going to be in your 50s or your 60s, and you're typically going to be in your, higher income earning years in your career. And usually in those cases too, sometimes it makes a little more sense to make pre-tax contributions. And unfortunately, these employees won't be able to do that this year or moving forward for the time being.
So Matt, talking about 401ks, 403bs, IRAs, another big chunk where people can put some money into is an HSA. What are the contribution limits for that this year?
Yeah, the HSA contribution limits have increased this year. So if you have single healthcare coverage, you can put in up to $4,400 per year into your HSA now. And then if you have family coverage, that increased to $8,750. And if you're going to be 55 or older by the end of the year, you can put in an additional $1,000 catch-up contribution as well into your HSA. Again, in order to be able to be HSA eligible, you do have to have what's considered a high deductible health insurance plan that is HSA qualified in order to actually open up an HSA and make those contributions for the year as well. So, we're in a brand new year. It kind of feels like we get this, clean slate in a sense. And, a lot of people have obviously resolutions when it comes to, their health, fitness. Also, finances is a huge part of people's New Year's resolutions. And I think it's important to, obviously focus on our New Year's goals, figuring those out for the year and how we can accomplish them. But also kind of going through some things that maybe were on the back burner, for a bit of time, maybe some things that were kind of on the to-do list that maybe, you didn't get done last year and, have carried it over into this year. And one of these things that I think is important for people to really look at every so often, maybe even every year or so, is their estate plan in reviewing that. So Matt, can you kind of take us through some things people should be considering, with reviewing their estate plan for the new year?
Yeah, absolutely. So the estate plan is kind of the thing that's flying under the radar, right? You have these top of line goals that are contributing to your 401k or contributing to an IRA or contributing to a Roth. Those are going to be top of mind for most people, each year in and year out. But underneath everything is what's going to happen with all that stuff if and when I pass away. And it's a tough conversation to have. Some clients are pretty reticent to have that conversation because they don't want to think about that sort of thing. But it is one of the most important things that we can provide on our side of the desk to kind of help them flesh out what works for them, what doesn't work, what they need, what they don't need. I like to use the term using too big of a stick. Are we using too big of a stick for what your goals are? So the first, top line with everything is going to be your will. Wills are incredibly important. Even if you think you don't have much to give, having a will in place is incredibly important, because if for nothing else, it gives your beneficiaries, whoever's receiving that money, some peace of mind as to how it should be taken care of, and then potentially has some court oversight into it, depending on how everything is structured. So if you don't have a will, or you haven't looked at your will in decades, it might be a good time to bust that thing out, take a look, and see what it says. I know that there's a will I'm a part of that I would be taken care of by my grandparents, and I'm 38 years old, so I don't think we need that anymore. So things like that, lives change, circumstances change. So whether it's, you've added grandkids, or more additional kids yourself to the pie, you want to make sure that all of those things are taken care of in a will. And another thing with a will is, what type of assets do you have, and what type of assets will the will potentially deal with? Essentially, we're going to have two silos, especially, with us and our clients, where most of them do have their retirement accounts and other types of brokerage accounts and things like that. Those are dealt with in a silo unto itself, and those are going to be dealt with beneficiary designations, which we'll touch on in a minute. But basically, anything that doesn't have a beneficiary designation is going to fall under the umbrella of your will, and it's going to be taken care of by what your will dictates. So you want to make sure that you look at your mix of assets. So big, top line assets that are going to be dealt with a will most of the time are going to be a house, tangible personal property. So your stuff, so your cars, your furniture, your carpets, your forks and spoons, you can get as granular as that. But depending on that mix there, you're going to want to make sure that you have your will in a place where it can deal with the stuff that will potentially fall under the jurisdiction of that will. The second biggest thing that we can do, on our side of the desk, is make sure that any account that has the ability to have a beneficiary designation, has one, whether it's correct or not. As long as there's one there, it still makes things a little bit easier. But B, making sure that the client has the beneficiaries designated on that account that they want to be on that account. Now, that can change. You can change the mix of beneficiaries at any point during your lifetime. So while things are fluid in your life, and more family members are being added, whether it's through marriage or through gaining grandchildren or anything along those lines, you want to make sure that whatever your goal is for those particular accounts are being satisfied by the beneficiary designations you have on the account. And that can be different for each account that you hold. It doesn't have to be the same. It just needs to be in a place where the client is comfortable with where that money is ultimately going. And then, there's other things that are that can go into the will. That can be some bigger overall planning that we do when it comes to maybe incorporating a trust into into the mix with a client. Maybe a trust is, like I said, too big of a stick to wield. So we look to other types of things that we can do for the client to help them get things to where they want it to go ultimately. Whether that's by incorporating a life estate into the process. And a life estate is you outright giving your home to whomever, typically to children, and you retain the right to live in that throughout for the rest of your lifetime. That's a tool that we use for Medicare and Medicaid planning quite a bit. That initial transfer will start that 5-year clock for Medicare and Medicaid purposes. So that's a tool in our utility belt that we can use to help, satisfy the goals of the client. A new thing that has come in New York State is what we call a transfer on death deed. That works basically the same as your beneficiary designations on your 401k or your brokerage account. Essentially, on the deed, you put a beneficiary on there, and the moment that the person passes away, the interest in that home transfers automatically to whomever is named on that deed. So it's a little bit of a quicker, it's a little bit of a cleaner process than a life estate, but that may or may not work depending on who the client is and what their goals are, because it doesn't transfer ownership. So it doesn't help from a Medicare, Medicaid standpoint or a transfer of assets standpoint. So, that's something that, we can take a look and say, okay, what are your goals? What do you want to do? Are we looking to start that 5-year clock, or are you just looking to make sure that this house gets into whomever's hands, upon your death? So we can kind of play with those two tools as well to help with a house per se. Some areas where a trust may not be that big of a stick and may be actually necessary or preferable, despite the administrative cost and burden that a trust may, create, is, did you buy a second home this year? And did you buy that second home in a different state? Something that flows under the radar there with that is, if you have a house in New York and a house in Florida, you go through probate in New York and you go through probate in Florida. And I've heard a lot of stories lately about people going through probate in Florida, and people have their complaints about New York State. Florida has a lot more. It's a bit of a mess. So especially if, you're the beneficiary, through a will or some other means, and you're going to receive that house and it has to go through the probate process. A lot of people don't think about that, and especially a lot of the people that are buying the homes and plan to give them to kids, grandkids, whomever it may be, they don't think about the burden on the recipients to have to go through probate in 2 states, and especially when they may not live in either of those states. You could have a New York and Florida home and somebody lives in California. So that, increases the burden quite a bit. So having what we call a revocable trust in place to put that second home can definitely relieve a lot of that burden. So if you've purchased a second home, this year, that is definitely something that you should bring up to us and say, is there something we can do to help, ease this process moving forward?
So like last year, if someone got a life insurance policy on themselves, or maybe even in years prior, I guess how does that sort of factor into the estate planning process?
So that's going to fit in, it's just another piece of the puzzle that we need to play with here. And the biggest thing with life insurance is going to be how much. If you have a $100,000 plan, a $250,000 plan, it's probably not changing the calculus too much. But if you're looking at getting $1 million+ policy, that's definitely something that we should know. And that's definitely something that should be, really taken into account in the overall estate plan, because we want to make sure that A, you don't bring too much money into your estate so you cause a taxable estate problem for yourself upon your passing. And B, these are larger chunks of money. A will can certainly deal with it to a certain degree, but for the most part, these plans are going to have beneficiaries on them where they get broken up. Okay, you have a couple $1 million policy. It's getting split up between 2 children. They're each getting a couple $1 million. Do you want your kids to have a couple $1 million, outright? Okay, if they're 40 years old and have a family, that's probably great, and it's probably something you'd be willing to just say, okay, they can have that. But if you have younger kids, you probably want to have some controls on that, and that's where we would utilize what we call an irrevocable life insurance trust, or an ILIT. You can move the policy in there. The policy will pay out to the trust, and then the trust will dictate how those funds are dispersed, whether it's all at once, whether it's over time. Basically, whatever you want to happen, you put into the trust, and that way you have some peace of mind that these larger sums of money are not just being spent freely by an 18-year-old. I don't know what I would have done if I was 18 and got a couple $1 million. So, a lot of parents and grandparents are concerned about those sorts of situations. So an ILIT would be a perfect place to put that, because it, again, helps the flow of money and helps the individual control that flow of money to their heirs. But, if we're dealing with even larger sums of money, it removes those funds from your estate, so you won't have any taxable estate issues upon your passing. So it really is a cool little tool that we have to use to be able to A, limit estate tax, and B, dictate the flow of money. And getting into that estate tax problem, there was some good news in regards to that this year. So the federal estate tax exemption was slated to be about $13.99 million this year. They bumped it up $1 million, just about $1 million. So the federal estate tax exemption is $15 million this year. Again, that's going to be indexed over time, so expect that to grow year over year. But right now we're at $15 million. And the federal estate tax is what we call the unified credit. So that accounts for two pieces. That accounts for the amount of stuff you have when you pass away. So house, brokerage accounts, 401ks, second homes, cars, all that stuff gets added together. And if you're below that $15 million, you don't owe any estate tax. However, if you do make gifts over the annual exclusion on a year-by-year basis, you may be chunking away at that $15 million. So any gifts that you make during the course of your life are going to be subtracted from that $15 million. So that will lessen the amount of stuff you're allowed to pass away with without paying estate tax. But if it's done correctly and done with some forethought, some thought, you're also going to be reducing that pile of stuff that you have over the course of your lifetime by giving those gifts. So it usually plays pretty well with each other. So just not too many people are going to be dealing with the estate tax problem on a federal level these days. But for those that are, it can be incredibly important to make sure that their estate plan is in place to, try to limit taxes as much as possible. New York State also has an estate tax limit. It's at a little under half of what the federal limit is right now. So that's at $7.35 million. There are some distinctions between the federal and the New York limits and what goes into it, what does not go into it. And gifts is one thing. New York has a 3-year look back on gifts, but theoretically you can have unlimited gifts during your lifetime. At the state level, they would be captured at the federal level. But at the state level, you're going to have unlimited gifts with a 3-year look back. And there's other nuances to the two, but that's something you can come in and talk to us, and we can go through with you if you are worried about hitting that limit at some point during your lifetime. So now that I've bored you to death with estate planning concepts, another thing that a lot of people don't want to talk about on a year-to-year basis is budgeting. So Hayden, how can we help on the budgeting side of things?
Right. So budgeting, thankfully, not as complicated anywhere as estate planning, but just as useful. So with budgeting, what we really want to focus on here is just really getting it set up. It can seem as in, a daunting task initially. You got to get out the Excel sheet, get out the big piece of paper, track every expense you had last year. It's a lot. But once you get it done, what we really like here is that it's very easy to update, right? So any life changes, more expenses here, more income there, easily updated, and it gives every dollar a purpose, right? So we eliminate some of those questions with our financial plan. Where is money going? Am I using it efficiently? Is everything working out right? The budget kind of answers those. But what we like to do, especially going along with the theme of our January episode, is reviewing what went well and what didn't. So sometimes people make a budget with the goal of, saving more, being more financially responsible. But like we said, every dollar has a purchase. So what we really want to focus on here is making sure we don't, underestimate too much how much we're going to be spending, right? So say you make a budget and you want to cut down on entertainment and vacations, some of those wants, not really a need categories, set that at maybe $4,000. If you overspend that to say $5,000, since every dollar is a purpose, you're going to have to pull that extra $1,000 out of somewhere, maybe more important, like a need, right? So we just want to make sure we're reviewing what went well, what didn't, and also setting a realistic budget for the year.
If someone has a 2026 goal of saving an emergency fund for the year, maybe that's on their to-do list, how can they best go about saving up that emergency fund, and where are the best spots to kind of keep the emergency fund for the year?
Yeah, so there's a couple of things you want to think about with the emergency fund. The number one thing I would say is liquidity, right? Because it's for emergencies, so things are sudden. You can't always plan on it. You don't have to liquidate it, wait, 3 to 5 business days, stuff like that. So a great place, I would say, is a high yield savings account, somewhere where you have direct access to. But the best way to go about your emergency fund, I would say, is kind of goes along with the budget, is finding out what are my expenses, right? And with that emergency fund, we want it to be between 3 to 6 months of those expenses. It depends exactly what the 3 to 6 months is. If you're more leveraged, if you only have, one income and your family, stuff like that can maybe move it more towards a 6 month emergency fund. Say you're single, don't have as much debt, stuff like that, maybe 3 months. But overall, we want to include that with our budget review is if you look at your budget and say, okay, I need to increase some expenses here. My income went up. I'm going to expend more this year. We want to make sure while our expenses or our income goes up, we want to make sure our emergency fund is also going up with that. Keep us in that 3 to 6 month range. Keep us adequately prepared for any curveballs life might throw at us.
I always think the beginning of the year, or even the end of the year, is always a great time to kind of review your investments as well. Review how you're allocated, because things can change from one year to the next. So Hayden, how can someone best go about looking at their portfolio and rebalancing it for the year?
Right. So along with what we just mentioned with our budgeting and our emergency fund, we want to make sure our portfolios still match our goals. So what you kind of alluded to there, and what we mean by that is when you initially set a goal in a portfolio, you could have a different need in the portfolio, maybe more growth focused, right? And as our time passes on and we move more from growth and the years pass by, and now we might moving into retention, we need to make sure our portfolio reflects that, right? Because sometimes we see your retail investors is you'll set your portfolio obviously more aggressive in the beginning, longer timeline. And as the timeline goes along, they're not adjusting it, right? We want to make those gradual adjustments. And what we mean by that is typically looking at the breakdown of equities versus fixed income. So in the beginning stages, if you're looking more towards growth, obviously that is more moving towards our equities, right? But as time moves on, we want to gradually progress away from those equities, increasing our fixed income exposure, protecting our capital, making sure our portfolio moves along with those years, right? And then more specifically moving into that is rebalancing. So with rebalancing, what we want to do there is make sure our portfolio and our investments are still at our target weights. So during the year, the portfolios that outperform will take up a higher percentage than initially set, and the ones that underperform will take up a lower percentage. So we call that as drift, right? So they move away from their target weights. And what we want to make sure is that we rebalance, we reset those to their target. So you do that by selling some of the outperformers, buying back some of the underperformers to get us back towards those goals. So what that would look like is, say you set a 60-40 portfolio, right? Very typical historical portfolio there. If you don't rebalance it over years go on, as we see with stocks typically outperforming bonds, those stocks will take up a larger percentage of your portfolio. And, say you don't rebalance for a couple of years, you might look back and your 60-40 could be a 70-30 or, 75-25. And what we really want to focus on there is making sure our portfolio is still at, if we need the 60-40, making sure it's still there, checking in. Because a lot of times you'll hear the term set it and forget it, right? And while that's great and that does serve a lot of purpose, you want to make sure we are reviewing it and we are making sure it's still aligned with our goals.
And, rebalancing too, just to, add a point there, the old adage with investing is buy low, sell high. And when you rebalance a portfolio and get it back to its target weights, you are essentially selling and investments that have gone up, right? If we do see that portfolio drift, maybe you want a 60-40 stock bond portfolio, and a year from now, right, equities, let's say, do very well, and maybe bonds just kind of stay flat. Maybe now that's more like a 70-30 portfolio. If we rebalance that, we're basically selling the investments that went up, the stocks, we're selling that, buying into the investments that maybe didn't do so hot for the year. So we are, by rebalancing, essentially following those old adage principles of, right, buy low and sell high, which I think is one of the most important benefits to rebalancing. Not just the fact that it gets us within those target weights that we want to sort of be at for the year. All right. Well, thanks for tuning in with us for our second episode of Plan, Protect, Invest, Scroy Lawley podcast. Hopefully we gave you some helpful tips to start the new year off right. And again, with any of this stuff, we're more than happy to obviously sit down with you, meet with you one-on-one, go through your 2026 goals, make sure you're set up properly, whether it be from an estate planning side of things, whether it be reviewing your investments and making sure, you're at where you should be, based on your age and your goals. And then obviously helping you set up and hit your 2026 financial goals. I think that's really where we can kind of help a lot of our clients to sort of be that accountability partner, right, in their lives. Usually friends, family members don't really talk about money a ton with one another. So it can sometimes be tough to get that accountability partner, in sometimes friends or family. So we can definitely help you be that, that partner throughout the year to, make sure that we're not only set up proper 2026 goals for you, but also hit them for the year as well. If you have any questions or you want to schedule in a meeting with us, you can just give us a call at 716-674-6700 or go to our website at scroylolly.com and you schedule in your financial review.